You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
Hey guys, I wanted to take this opportunity to remind you all to like and subscribe. It really helps me to keep getting the best guests onto the podcast. So I really appreciate it if you did. And now onto the video. Hey guys, welcome back to another episode of Market Champions. Today we've got Mike Alkin and Tim Chilleri from Sachem Cove Partners. They're here to talk about investing in uranium and the uranium thesis. So thank you so much for being on the podcast, and I'm glad to have you.
Our pleasure.
Absolutely.
So I wanted to start off with a bit about your background, both of you. Could you sort of talk about your journey to Wall Street and how you got to where you are today? So we can start with Mike.
Sure. I started about 25 years ago or so. I have an accounting degree. I was getting a master's in journalism, and I started working at a magazine and a financial magazine. And I saw what the sources were. They were hedge fund and mutual fund guys. And it was suggested to me by one of the editors that I go and look at a hedge fund position because I understood the balance sheets and the cash flow statements. And I did, and I met with a few guys, and somebody gave me an opportunity. And first few years, I spent a lot of time working exclusively on the short side of doing deep dive fundamental research away from where the consensus was formed, which was the sell side investment banks. Did our own research, and then you learned a great deal being a short seller in how to have a contrarian view and how to ignore consensus, appreciate it, respect it, but then go look away from where the sausage is made and see what it really looks like. And so I did that. And the first half of my career, I spent a lot of time on the short side. And then I became a partner at a pretty large hedge fund. And there it had a fair amount of, still did a fair amount of short selling, but had a very deep value tilt to it. And the partner at the firm who started it had a very long storied track record, and it taught patience and looking for asymmetry and find things that others are ignoring. And it was really there that the whole world opened up to me in terms of thinking about, rather than chasing the same investments other people are, because I'm not that bright and who am I to think that I know something more than 10,000 other eyeballs looking at it? So go find things others aren't paying attention to. And so that was really, for many years now, has been the style of investing that I've, call it fact-based, call it contrarian, call it finding the unloved, whatever it might be. But that's how I've done it. And 5 years ago, started looking at uranium, and 2.5 years ago, launched a fund on it after doing a lot of research and meeting Tim. And Tim and I did a lot of work beforehand, and there we go. So Tim, you want to?
Yeah, sure. So I started pretty early in my life, just had an interest. I played a lot of sports growing up and was introduced to it while I was a teenager. And it kind of fit a lot of my interests. As a competitive person, there was a lot of, research, economics, geography, politics, a lot of interests of mine kind of that came together into one. So I pursued it going into university. I majored in economics, which, we could have a lengthy debate about how useful economics is being taught in Western universities today. But, and at that time, when I was in university in the early 2000s, in the later part of 04, 08, we saw the dramatic rise of commodities and the influence of China coming into the market. And that really perked my interest. And I coincidentally had a friend in high school whose father had run his own capital for many years for his family. And he told me that I pretty much had a decision if I wanted to go to Wall Street to either go into the equities or commodities, kind of that route. And commodities had always perked my interest. So I ended up starting my career in Chicago as a futures and options broker, which was a great experience to just track all sorts of the various financial markets and all the listed products within the CME group and all the products that they have. Did that for several years, and then I had an opportunity to join a physical commodity trading firm, and we traded niche commodities. I worked specifically in the cashew market, and this really led me, and doing this after a few years, it led me to believe that there was real opportunity in niche markets, that there's all sorts of markets in the world, and that a lot of people focus on the very popular ones that you see on TV or the easy access on your telephone. But there are so many others where it's tough to develop, or it's tough to get access to some of these markets. And I realized that we had a real edge, and I was always successful in some of these niche markets. And so several years ago, I started looking while I was working as a physical trader for some bombed out markets on the long side, stumbled into uranium. And I also ultimately stumbled into Mike as well, who coincidentally was looking at it as back in 2015, 2016. And it just kind of, as we went further and further down the road learning about it, it seemed like a great opportunity. And that's kind of a long-winded way of how I arrived to where I am now.
And that's awesome. Now, why don't you kick off the interview by sort of talking about the size of uranium and the size of the uranium industry? So sort of how much of a collapse have you seen in the market cap of uranium mining compared to where it was, say, pre-Fukushima? And what's the total addressable market and demand like?
Sure. So if you go back at the peak of the last cycle in the mid 07 time period, 2007, if you looked at all the companies that had something to do with uranium, you're pushing $150 billion. And then if you go into 2016-ish, late 15, 16, that time frame, you were looking at about the public market capitalizations were $4 billion. So quite a big drawdown. I think at one time there were close to 500 companies that were in and around the area. And then back in the 15, 16 time period, it was less than 50. So you saw a significant drawdown of market cap. And with that, you saw, institutional investors leave the sector. And you also saw the sell side, for the most part, with the exception of a few smaller firms, leave the sector. And so when the sell side, the big investment banks, abandon something, it tends to feed off itself, and investors then lose interest. And so that was that. It's grown a bit now. Kazatomprom came public in 18, latter part of 18, which added several billion to the market cap. And this year, some of the stocks have had a good move. So, you're probably in the mid-teens, high teens, haven't looked exactly at the exact market cap of the industry, but still, a far way off of what it was at the last peak. In terms of the individual commodity that goes to feed nuclear power, nuclear power is roughly 12%, 11 to 12% of global power production. And depending on what estimates you look at, over the next decade, demand roughly is about a couple 100 million pounds a year. And then put a price on the price of the commodity, and that will tell you the size of the market. A couple 100 million pounds times X dollars, and that will give you the market cap, the market size, dollar size.
Right. Tim, do you have anything to add to that?
No, I think Mike covered it pretty well. That's a good kind of general lead into probably some more relevant discussion points. But at the end of the day, think about uranium. In uranium, when we talk about it in terms of U3O8, the feedstock that ultimately gets enriched, this is a very, very small market cap for publicly listed stocks. Like Mike said, in the mid-teens, so call it 16, 17 billion today for 11% or so of global electricity production. That's pretty nominal relative to some of the IPOs we've seen or other asset classes that we've seen. Very, very small today.
And as you say that, it is very, very small. So how should we be thinking about the nuclear power industry, and what is it going to take for the psychology to shift? A lot of people just say that nuclear isn't safe. They point to Chernobyl or Fukushima. So what is it going to take for the psychology to shift around this industry?
It's a good question. The industry itself has had a public relations problem. A lot of it brought on by itself. their own advertising years ago, if you even call it advertising, it was always with the nuclear sign, and the emphasis on clean power, carbon-free power, it never really resonated. These are 900 megawatts, 1 gigawatt reactors that put power to 800,000, 1 million homes with clean carbon-free electricity. You've had 3 incidents, 3 Mile Island, Fukushima, Chernobyl, even including those where unfortunately some people passed near and around the plants. On a per terawatt hour, nuclear is the safest form of electricity production. That's a message that they don't really get out there, the nuclear power industry. So you kind of have to research it and know it. It's not something that's in the public realm. But where you see it, it's really a tale of a couple of different geographies. In the West, in the United States and in Western Europe, it's a more mature industry. I wouldn't characterize it as a growth industry. It's stable to slightly declining. But all the growth is coming from the emerging markets, Russia, China, the Middle East, other areas that they are building reactors in. And when you put it all in the hopper and you take the builds minus the losses, it's a growth business. It's not a sexy growth business. It's a 1-2% grower, but it's growing nonetheless. I think what we've seen over the last 18, 24 months, there has been a bigger body of people that have recognized if you're going to attain your carbon neutral goals, you can't just get there by going wind and solar. While
Right.
wind and solar will have rapid growth, people tend to make them one or the other. It's either nuclear or it's alternatives. Tim and I think they're quite complementary because, the base load element of nuclear, it's always on, it's a workhorse.
Right.
It's
Exactly.
working 340 days a year. Wind and solar working quite a fraction of that. And, but it doesn't mean one's better than the other. I think they both have their place. You won't have the growth rate out of nuclear, but if you're that you do out of wind and solar, but that's not what the investment is based on. The investment is based on price and value of the commodity, which we think is undervalued dramatically.
Yeah, absolutely. No question. I mean, wind and solar should be viewed as wonderful supplements to the grid, to base load. If there weren't some of the curtailment rates that we see with wind and solar, sure, it would be fantastic to have all the time. But the fact of the matter is that's just not the case. So again, we do feel like it's a wonderful complement to nuclear and some of the other base loads, power sources. But to say that wind and solar should be, the primary source or, 100%, we certainly wouldn't agree with.
Right. And I wanted to ask you to sort of comment on that. So, what price does uranium need to be before the other operations come online? And given sort of the current usage estimates, how long before supply runs out and it actually gets there?
We always say price is everything. Price will incentivize at some point. Price incentivize is production. We think to balance the market, right? You could be in the $65, $70 range where supply balances with demand, but that doesn't work. That works on paper. The price got down into the high teens a few years ago when the marginal cost of production is close to $50 a pound. So you would say, well, how could it get there? Well, there was some excess supply and it just kept coming out. And now that's kind of it has worked its way through. But, to incentivize produce our on maintenance rate that in, you're probably looking at $50 a pound. But you have to think about a lot of when Tim and I see a lot of commentary, we see it very binary. What's that price? We think about it as though a supply stack pyramid. The low cost providers could come in at a lower price, but they can only fill out X number of pounds, less than 100 million pounds, right? The market's a 200 million pound user over a decade. So sure, your lower cost guys can fill that up, and then you start working up the stack, and that's where you start to really need the higher prices. Now that's on paper, and then of course you have market psychology that kicks in. In the last cycle, we saw the price go to 137. It never needed to get there. It could have been fine in the 70s, but you get this period where it's, nuclear and uranium is a very interesting sector because the buyers are only, the cohort are nuclear power plants. You don't have speculation in the market like you do in most other commodities.
Right.
And so they drive the big contracting cycles. And if you look back to the early 2000s, they were contracting at about a third of what their annual consumption was. And then when prices started rising and they feared a lack of supply availability, they contracted at around 150% of their annual consumption.
Right.
Best at the top. Now, fast forward now, for the last 7 years, they've been contracting about 37% of annual consumption at the bottoms. So, what happens at the next run, it just depends what they want to do to secure it. Where we know it has to go, or believe it has to go, is from these price levels, well more than double.
Yeah, one thing, and per Mike's point, he's absolutely right, and that's a general comment about the marginal price being $50. If anyone's dug into the market, they know that there is a byproduct producer, who produces pounds very cheaply. I think anyone who spent time in this market knows that the Kazakhs and ISR mining is some of the real tier 1 pounds that come into this market, and like Mike said, they can only fill so much, and because of that, we seem to get a sense of just interacting with a lot of market participants and various entities in the market, is that we see a confusion between what the cost might be at the mine level, then what the cost might be all in at the corporate level, and then there's the price you need to return capital to shareholders. So there's a bit of a confusion in this market, I believe, in terms of what the cost of something is and what the actual required selling price is. And because prices have been relatively in the doldrums for the last few years, the attention has been on what is the cost to pull it out of the ground, as opposed to what is the cost that the producers need to cover the life of mine costs and return some capital to shareholders. So that's something that maybe people should spend a little bit more time on and thinking about, and how this might play out over the next few years.
Yeah, and you would even see it in the some of the analysts that write research on it. When the market was higher, their cost curve was an all-in sustaining cost curve. What it took at the corporate level to do it, that was the cost curve. And then as prices kept sinking and sinking and sinking, all of a sudden the cost curve became just a cash cost curve, ignoring those other costs. So a mine 1 year, they had on the cost curve X, and then 3-4 years later, it was X minus a lot to the cost. Well, ultimately supply cuts came because those mines need X plus whatever that real cost is. So yeah, you see a lot of, Tim and I see a lot of that when they're talking about costs. Supply, demand, all needs to be put into context. It's not just a specific number.
Right, and I wanted to stay with the producer for a minute. And Tim, I wanted to ask this to you first. So, what is the capacity like for the current producers, and is there enough capacity at all in the industry right now?
Well, it's a good question. There is capacity available. The problem is that the price does not support that capacity. And we hear it all the time where, someone will say, well, there's all these mines on care and maintenance. They'll come back. They will come back. There's no question they're going to come back. But they're going to come back at a price that is appropriate to support that production. And by the time the price gets to those levels to support that production, some of the investment opportunities that are available, we feel that there are investment opportunities today, will probably be a lot different in that scenario. Now, when will that price get there? Well, it depends on the operation. It depends on the type of mining, and it depends on how different producers view how to return capital to shareholders at the end of the day. So you may see some people maybe selling a bit aggressively to get some contracts on the book, to maybe get some financing to get things going. You could see others waiting it out because they can say, you know, we can ride it out now, knowing that there will be plenty of demand coming to us in the middle part of the 2020s. So it's a little bit dependent on the operation, but at the end of the day, as Mike said, and as we say, price is everything. This is any returns in terms of care and maintenance mines coming back, any of the greenfield development that is ultimately going to be needed in the middle to back half of this decade is price dependent. So sure. So let me give you an example. There's every 2 years, a big book comes out called the Red Book. And basically it's a 450-page document that says at the end of the day, there's lots of uranium on Earth. Right. Well, that's wonderful, but at what price? And that's what our investment thesis and horizon is all about, is what are the prices needed to support this production? And ultimately, because of that, that's when you're going to see those capacities come back to the market that are available, but under the right circumstances and prices.
And also I'll add with the existing production that's out there, even on care and maintenance, when you account for the mines that will be depleting over the next several years, there's new mines that are needed. And so building a mine is not just a technological feat and an engineering feat, but it's a financing feat and it's a permitting feat. And those are long timelines. So, for those to come online, you need a lot to go right. And those will be needed. And what has to go right is price.
Yeah, and early on when we were looking at this thesis and idea and trying to understand it, one of the big light bulb moments for us was the delay in supply coming to the market, in the sense of new production coming to the market. This is not natural gas. Okay, this is not shale fracking, right, where you can just kind of, okay, prices go up 10, 20, 40%, and let's kind of flip a switch. We'll get out there in the well field, start drilling stuff, and boom, bring that to market. This is totally different in uranium. It takes years. Let's say theoretically, long-term prices, spot, whatever, get to $50, $60 a price, $70 a price to bring all this production. Well, just because the price gets there doesn't mean that the asset can be developed overnight. They need to get through their feasibility studies. They need to talk to banks. They need to get their permits in place. They need to actually build the mine. And these are not in places typically that are in the middle, right by everybody. They're in remote locations sometimes. So getting the technical, getting the actual capital, getting the actual labor, this takes many, many years. So the price can go there tomorrow, but just because the price goes there doesn't mean that there's going to be a supply response.
And as you use that example, you compared shale to uranium, where shale, you could just start a reactor pretty quickly compared to uranium, where it takes a very long time to build a new plant. So now, are there actually new plants being built? And now, when will these new reactors that are being built sort of come online and be integrated into the grid?
You have a little over 50 reactors under construction right now. And depending on the year, some years 4, some years 6, some years 8 will come onto the grid. Then you have some that retire also. So you look at net numbers. But you're seeing approvals frequently of new reactors that will start construction, not just in the planning stage, but got approval and will start to hit the ground. So you're going to have a very steady stream of reactors coming on for the foreseeable future, as far as the eye can see, in terms of new starts. And that's another thing, we see a lot of commentary. So a country might be closing a reactor or two, and that's the headline. Okay, but how many have started and under construction and coming onto the grid? Again, it's the net number you have to look at.
Yeah, and also, one further point, it is the net number. You also want to make sure that you're looking at, the megawatts or gigawatts, because, for example, in the U.S., a lot of older reactors are being shut down that tend to be much smaller, maybe in the 500, 600, 700 megawatt range. But some of the new ones coming on are 1,100 megawatts, or said another way, 1.1 gigawatts. 1.6 gigawatts. So a lot of the new reactors that are being constructed, particularly in the places we talked about, the Middle East, Russia, China, they are building enormous size reactors relative to the ones being constructed 40, 50 years ago. So they're ultimately using much more uranium. So take a look at that megawatt or gigawatt number and add them up, the new builds that are coming, subtracted by any of the ones coming out to get your net number. And that's the way that we look at it.
I believe in your presentation on Macro Voices, you mentioned that, or at least on the presentation, you mentioned that there's asymmetry due to complex and a very opaque nuclear fuel cycle. Could you describe the cycle and how it works?
Sure. So there's many stages to the fuel cycle. You mine uranium out of the ground and you get U3O8 and you crush it into something called yellow cake. And that gets sent off to a conversion facility where they turn it into UF6, which is a gas. And once they do that, they send it to an enrichment plant where they enrich it so that it's fissile in nature enough to go into a fuel rod into a nuclear reactor. From the enrichment plant, it goes to a fabricator where it's put into pellets about the size of your thumbnail. It gets put into rods that get shipped off to the reactor. That could be 18 to 24 months. That's called the fuel cycle. And so it doesn't just come out of the ground as uranium and go into a reactor. It goes through many, many steps to do that, which each have different prices. There's the price of uranium, the price of conversion, the price of enrichment, which is called SWU, the price of fabrication. So there's many steps along the way.
Yeah, and just generally, first of all, it's not a highly followed market. The vast majority of investors, including commodity investors or energy investors, tend, for whatever reason, not to look at uranium. It's just a very small kind of ecosystem, if you will. And so because of that, there aren't a lot of eyeballs on it. Because there are not a lot of eyeballs on it, there are not a lot of resources and transparency just in terms of what's going on with the U3O8 price. In fact, there's a few consultants and price reporters out there that report the price on a daily basis. I mean, I can tell you, watching this market, quote unquote, trade every day for the last 4 to 5 years, it's the equivalent of watching paint dry. If you're coming from oil or gold and you're watching your futures platform, and these prices are sizzling around with billions of dollars per day in notional value trading, you are going to tear your eyes out watching uranium trade, because it doesn't do anything day to day. There's no trading happening all the time. I mean, there are days where you don't see it move. So in the industry, we call that trading by appointment. But so because of that, and whatever other various factors, people are paying attention to it. And so it just kind of, I guess in a certain way, brings its own kind of mysteriousness and opaqueness to it, because there are not a lot of price indications in real time. And that's just for the U3O8 market. We're not even talking about the fuel cycle going to conversion. There's a price for conversion. That's a service fee that utilities pay to converters to convert it from U3O8 to something called UF6, uranium hexafluoride. There's a price for the enrichment service, SWU, separative work units. So that's even going further down the rabbit hole, if you will. And due to these factors, there just isn't a girth of information and people paying attention to what's happening. And therefore, it's kind of left to its own devices, if you will.
Got it. That makes a lot of sense. I wanted to go on to some interesting developments that have happened recently. So recently, the Department of Energy in the new stimulus bill has authorized $35 million a year for the next 5 years for development, demonstration, and transportation activities for uranium. So how do you see that affecting the industry?
I mean, it's anytime the Department of Defense gets behind something, they tend to get what they want, and it's good for awareness. It's good for stimulating research and spending. So that's good. As we look at it in the totality of the supply-demand picture for uranium, it doesn't really impact at all how we think about the price of uranium. But it is, anytime that they are supporting it, it's more of a net positive than not.
Right. So in one of our email exchanges, you described that, new technologies in uranium have been around the corner, but the corner keeps getting wider. So what is it that actually causes, this sort of phenomenon to happen?
Yeah.
I'm just curious.
Technology is hard in this. It's, the old reactors, you've had a few accidents, but they've really, since they've learned a lot of lessons and they've reinforced them, and they're still pretty damn reliable to begin with when you think about in the totality of all of it. But you've seen a lot of discussion on all of these generational reactors that have been out there for many, many years, and it just takes a tremendous amount of not only technology and understanding and research, but capital. And so getting the capital there, it has fits and starts. Meanwhile, the existing reactors, they get their licenses extended for sometimes 20 years. So, there are interesting technologies on the horizon, just not tomorrow, not for this investment cycle. One of the newer ones, small modular reactors, that will have a nice complementary role in nuclear. And again, that's going to come down the road. And will be very, very, very good for the industry. But for people who are investing in this cycle for the foreseeable future, it's really, what do we have now? And what's the price of the uranium that's required to get there?
Yeah, and I think, just like the uranium price itself is very cyclical, I think the views towards it and its pros and cons, benefits and not of nuclear power are cyclical too. In the early part of this millennium and the 03, 06 period, people call that kind of the nuclear renaissance, and it was very back in favor. Oil prices were screaming higher during this period. So it was, how are we going to have enough energy for around the world? And it was very hip and very in favor. And then Fukushima happened in 2011, of course, and it kind of fell out of favor. Whereas, does nuclear really play a role? Is it really that big of a deal? Oil prices had oil prices were still a bit high there in 11, then kind of subsequently fell. And, there was a narrative that maybe we don't need nuclear. And now, once again, we're turning, and we're seeing that, as a part of this energy transition, nuclear has to be a part of it. And it seems to be gaining some momentum again, that this could be at minimum a bridge to the future, if not a piece of the overall puzzle.
Go back to a point Tim made earlier about the spot market where, uranium doesn't trade that much at all. So where are sort of the spot market pounds coming from? And both Cameco and Kazatomprom are net buyers in the spot market. And, what happens if spot supply can't fulfill this demand, and how likely is this event to occur?
Yeah, well, there's a couple places where it comes from. There are some low-cost producers that do sell into the spot market, whether it's because uranium is a byproduct, or they have low-cost operations out there in the world where they are selling into the market. There are some financial intermediaries or traders in the market that do have some offtake agreements that come, every 30 days or once a month or so, where they're getting some material. And due to these financial intermediaries' business model and small balance sheets, they tend to sell them into the market pretty quickly. They're not really built as a business to take in uranium and just hold on to it for years because they think the price is going up, and they're going to sell, when the prices get to 50 or 60 or 70, if that ever happens, which we think it will, but we'll see. So they're not really structured to do that. So their job is to take pounds and sell them into the market. They don't have the balance sheet or the risk to do that. They're not really built to do that. So there are pounds that flow into the spot market every single month. With that said, I think sometimes people conflate this idea of a few, loose pounds, whether it's 1 million or 2 million pounds a month, coming into the market with the structural deficit that has formed and will be sustained for many years moving forward. And again, it goes back to that market structure. If the utilities are not really active in the market, there's not a whole lot of other buyers for U3O8. There could be some trading firms, some producers, some financial people like hedge funds or that sort. There's some physical vehicles that could potentially buy some as well. But at the end of the day, if the utilities aren't there in the spot market day to day, yeah, you can see some fluctuations in price in the spot market, but that really doesn't have a whole lot to do with the structural supply and demand backdrop that we have built our thesis around.
And even when prices were in the 130s and stuff, you're still trading 25, 30 million pounds a year in the spot market, just random pounds that appear. When prices had gone from, $10 to 137, there's always pounds floating around somewhere. It's
And to further that, because sometimes we hear, when is spot going to run out? When is it going to dry up? There will always be pounds in the spot market, whether the price is $5 or $5,000 a pound. There will always be traders in the market buying and selling this stuff. So it's just a part of any market. So when we hear the phrase, when is spot going to dry up? I think it's not, it tells me that maybe somebody might be misunderstanding the market a little bit.
Yeah.
To wrap up the podcast, I wanted to ask you, do you have sort of like the antithesis onto your thesis? What could go wrong and what are the risks in playing this bullish case?
It's every day. It's a good question. Every day we started looking at uranium, trying to prove the bear case. Is there too much inventory? What would it take for the inventory to continue to be at these levels? So you needed to see a series of things start to kick in, because there was at one point back in 2016, there was way too much inventory. There was too much supply. We just mentioned the spot market. Sometimes there's a few pounds in there. Sometimes there's a lot of pounds in there. So we look at things as to producer discipline. Right? Is there anyone out there that would restart their mines because they've lost their mind and
Right.
and all of a sudden they're going to do that? Have their costs lowered dramatically? No. We a lot of times we hear, well, the Kazakhs could ramp production. Okay, we say that's fine. Again, contextually, they can, and if they do, there's still a really big deficit. Right. So it's all about context. On the secondary side, there was something called underfeeding, that the enrichers were able to extract more uranium from an order than the order called for, and they would sell that into the market. So to get our head around that, we spent quite a bit of time of understanding supply demand in the separative work unit space, capacity, capital spending there. Inventories that people are willing to just burn down to really unsafe levels of security of supply. So
Right.
there are things that we're always every day trying to figure out what we could be missing.
Right. And with that, thank you so much for being on the podcast. It was
Our
awesome
pleasure.
having you.
You bet. Our
Thanks
pleasure.
for having us. It was nice
Thank you.
talking. Take
Thank you.
care. Okay.
See you.
See ya.